Good morning, class. Welcome to our second lecture of investment management. Looking at what we were having a recap of what we were looking at last time, we were looking at the introduction of investment management, and we defined what investment management is about. And we saw that in as much as you are making investment decisions, you need to look at two things, which is risk and return, and also the term value of money. You would decide to make an investment today because that investment in the future, when you look at it, it is going to generate you more than what you have invested today. That is the whole point about investments. When you're investing into something, you have to make sure that the returns of that investment are greater than the initial amount or the initial resources that you started with. That is because it will be pointless for you to start an investment today, and at the end of the day, you realize losses. It will be pointless for you to do that. And then we looked at investment, that in as much as you are investing into something today, you need to look at efficiency. You need to make sure that you use fewer resources in generating maximum output. And in as much as you are being efficient, you have to make sure that you are sustaining the resources, because most resources that we deal with in real life are scarce resources, and most of them are not renewable at the end of the day. That is why you need efficiency, and you have to allocate resources efficiently. Then you have to make sure that the investments that you are doing, you meet the objectives that you desire to have at the end of the day. You also have to make sure that the investments that you're making are made at the right time, and also that resources are allocated to the right investments. We saw that an investment, it is a sacrifice that you will make today in order to generate a future return. And we also looked at present value and future value. Then we saw that for future value, you have to compound. And then we also gave the formulas for future value, and for present value, for you to find present value, you have to discount, meaning that you get a future value, you discount it for the interest rate, and then you take it backwards in time until the present value is met. And then we saw that when you're making decisions between two amounts, let's say one amount is in the future terms and the other amount is in the present terms, you have to make sure that in as much as you are making those comparisons, those two values are in the same terms, meaning that if you have a present value and you have a future value, meaning you have to make sure that that future value should be discounted for to the present value. Or if you want, you can convert that present value by compounding it to a future value, and then you'll be able to compare the two. You cannot compare a present value to a future value. That is because those two values are not in the same terms. And we also saw that there are some reasons why you would prefer to get money today and invest it, unlike getting money in the future that is promised to you. For today, we are going to look at the present value and the opportunity cost of capital. So most of the things that we are going to deal with onwards, starting from the formula of present value and the formula of future value. Most of the things that we are going to deal with are things to do with formulas. There's nothing complicated. You don't have to be scared of anything when you see the formulas. All that will be happening is you have the formula and you'll be given some numbers, and those numbers you're going to be putting them in the formula. That's all. That is the only thing that you're going to be doing. You know that if you're finding a square root of something, you have a formula, which is the square root. And then if you're given numbers, you're just going to be putting numbers in that same square root. So just for example, for future value, you have FB is equals to CO, open bracket, you've got 1 plus the interest rate, you close it, and then you've got the number of years. That is just a formula, and you'll be given numbers to put in that formula. So there's nothing complicated about investment management. This is because you will be able to adapt to it and make sure that you solve the things at the end of the day, because the things that you're going to be dealing with are things with formulas already. There's nothing complicated about it. So today we look at present value and the opportunity cost of capital. Then topics covered: why valuation, net present value, net present value rule, risk and present value, rate of return rule, and the opportunity cost of capital. Why valuation? A corporation's shareholders want maximum value and maximum share price. You agree with me that you, as a shareholder of a business, you invest your shares in that business. Your goal as an investment manager or as an investor, you have to make sure that the returns that you will have will be of maximum value and they will have a maximum share price. That is going to be one of your goals as a shareholder of a given entity. And you make sure that in as much as you are carrying out your activities every day, your objectives at the end of the day is to make sure that you have maximum profit. Those are the things that you're going to be looking at when you have ventured into an investment as a shareholder, because you, as the owner of a business, an investment, it wouldn't profit you to continue doing something that is giving you losses. Hence, as a shareholder, you're going to look at maximum value and the maximum share price. To reach this goal, the company needs to invest in real assets that are worth more than they cost. So we see that in as much as you're investing, so we are on this point, in as much as you're investing in something, you have to invest in something that is going to give you something more than what it costed you to invest it. That is what you're going to look at. You make sure that you invest in that asset that is worth more than it costs, because that will be something positive to you as a shareholder, because you're making profit at the end of the day out of the minimum resources that you used to invest. It becomes critical for corporate managers to understand how assets are valued and capital investments are made. Why evaluation, for example? How do you decide whether an investment opportunity is worth undertaking? Suppose you own a small company that is contemplating construction of an office block. The total cost of buying the land and constructing the building is 350. See, this is the cost of buying the building. But your real estate advisor forecasts a shortage of office space a year from now and predicts that you will be able to sell the building for 400 million kwacha. You see? The cost of constructing and the revenue of selling that building at the end of the year. For simplicity, we will assume that this 400 million kwacha is a sure thing. So when you're making an investment, you are not 100% sure that this is the actual figure that I will receive at the end of the day. But for simplicity's sake, we are going to assume that you know the amount that you're going to receive at the end of the day. Then this is the cost and this is the revenue if you sell. So the question now that you have is, should you invest? Let's see. You should go ahead with the project only if the present value of the cash flow is greater than the 350 kwacha. So like I was saying, if you want to compare two values, you have to make sure that those values are in the same terms. Present value against present value, or future value against future value. That is how you can compare. And we see that this 350 was the cost, and the 400 million kwacha was the revenue if that office block was to be sold. So what are we going to do? Suppose the rate of interest on government securities is 7% per year. So that is the interest rate. So, and then forecast cash flows. So the cost of building was 350. That was the cost of building. The sale price in year one was 400. So we've seen that this was the cost and the revenue was 400 if we sell that that building. Then step number 2, we estimate the opportunity cost of why valuation. Example. How do you decide whether an investment opportunity is worth undertaking? Suppose you own a small company that is contemplating construction of an office block. The total cost of buying the land and constructing the building is 350 million kwacha. But your real estate advisor forecasts a shortage of office space a year from now and predicts that you will be able to sell the building for 400 million kwacha. For simplicity, we will assume that this 400 million kwacha is a sure thing. Should you invest? You should go ahead with the project only if the present value of the cash flow is greater than the 350 million investment. Suppose the interest rate on government securities is 7% per year. So, like I said, you'll be able to compare two figures if they're in the same terms, they're in the same time space. For example, if you want to compare a present value, you have to make sure that that future value that you have or that you are given, you have to discount it until you have the present value of it. So for example, in this case, we had the 400 million kwacha, which was our future value, and the 350 million kwacha, which was our present value. We will discount the 400 million kwacha to present value, and if the present value of the 400 million kwacha will be greater than the 350, then we should go ahead with the investment. That is what it says. You should go ahead with the project only if the present value of the cash inflows is greater than the 350 million kwacha investment. Step number 1, forecast cash flows. So we've got the cost of building, which is 350 million kwacha, and then the sale price at the end of 1 year is 450 million kwacha. Step 2, estimate opportunity cost of capital. If equally risked, investments in the capital market offer a return of 7%, then the cost of capital is the interest rate, which is 7%. It is an opportunity cost because it is the return that is forgone by investing in the project rather than investing in financial markets. So that is the definition of opportunity cost. Something that you are going to forgo in order for you to do something. That is opportunity cost. It is an opportunity cost because it is the return that is forgone by investing in a project rather than investing in financial markets. So we see here that this person wanted to build an office block. And then away from deciding to invest in financial markets, he decided to build the office block. And the opportunity cost at the end of the day was the financial markets. Step number 3, discount future cash flows to the present value. So like I said, for you to compare two values or two figures, you have to make sure that they're in the same time period. So for present value, you have to make sure that the future cash flow is also discounted for until you have it in present value. So we had 400 million kwacha. The formula for present value is PV is equals to C1 over 1 plus the interest rate. So like I said, we have formulas in this course and there's nothing complicated. Everything is straightforward. You'll be given the numbers and all you have to do at the end of the day is get those numbers and put them in the formula. So for our future cash flow, which is represented by C1, which was the cash flow in year 1, was 400 million. And then where there's the interest rate, we had 7%, and then converting it into decimal, dividing it by 100, we got 0.07. Then finding the calculation, we had 274 million kwacha at the end of the day. This is the present value of the 400 million that we had in the future, or that we are going to receive at the end of year 1. Then we see that the cost of building the office block was 350. And then the present value of the future cash flow of 400 is 374. And we see that if this value is greater than the cost of building the office block, using the rule of present value, we have to go ahead with the investment. This is because it is more costly for us to venture into financial investments compared to what we can invest in using the 350 million kwacha. So present value was found by discounting the future cash flows by its opportunity cost. So number 4, step 4, go ahead if the present value of payoffs exceeds investments. So this is NPV. Net present value equals the present value minus the required investments. And if the value that we are going to get when we add the cost and the present value, if the value that we are going to get is positive, we should go ahead with the investments. If the value that we are going to get is negative, then we shouldn't go ahead with the investment. That simply means that that investment at the end of the day is going to give us losses. So in as much as you are investing in something, you have to make sure that you invest into an asset that is going to generate more than the cost that you've encountered when investing into that asset. Net present value. So NPV is equals to the present value minus the required investment, which is NPV is equals to CO plus, this formula is the formula for present value. And then the CO in this case, looking at our example, the CO was just like the cost of building the office block, which was the 350. And it has to be subtracted from the present value. And if the subtraction is going to give us a positive number, then that investment is good at the end of the day. But if the calculation of NPV is going to give us a negative number, then it is not a good investment to go ahead with. The NPV rule, therefore, is accept investments that have positive net present value. So this is the net present value rule. Accept investments that have positive net present value. Risk and present value. We made one unrealistic assumption in our discussion of the office building development. You cannot be certain about the profitability of an office building. So if you invest in something today, you wouldn't know the exact figure that you're going to get at the end of the day. That is what we are trying to say here. You invest a 10 kwacha today, you don't know exactly the amount that you will get at the end of the year. If the cash flows are uncertain, your calculation of NPV is wrong. Investors could achieve this same cash flow with certainty by buying 374 worth of government securities. So they would not buy your building for that amount. You would have to cut your asking price to attract investors' interest. How? Realize that the office building development is more risky than a government security. Suppose you believe the project is as risky as investing in the stock market and that stocks offer a 12% expected return. Then 12% is the opportunity cost of capital. Use this rate to discount your future value of the building. Higher risk projects require higher rate of return. So the more risky a project is, then we expect that that project has higher returns. Higher required rates of return cause lower present values. So if we've got a higher interest rate when we are discounting a future value to a present value, we will see that the return of that present value is going to be lowered. Present value of cash flow in year one was 400 at 12%. So earlier we saw that at 7%, the return of cash flow of 400 million gave us 374. Now let us see what would be the present value if we make sure that the building, the selling of the office block, the interest the interest of selling the office block is equal to the government securities. And then we see that the interest rate has been raised from 7% to 12%. Let us see now what will happen by discounting the 400 million kwacha using 12% as our interest rate. So we've got the present value now of the 400 kwacha using 12%. So the present value will be 400 divided by 1 plus 0.12. So this 0.12 was the interest rate. Which was 12 divided by 100, giving us 0.12. If we calculate the present value of the cash flow of year 1, 400 million, we'll get 357. Then we see that this is now the present value in relation to a 12% interest rate, which is equal to the way somebody can get government securities in the stock market. So we still see that this value is greater than the 350, which was the cost of investing into the building of an office block. And we concluded to say that if the present value is greater than the cost of an investment, you should be able to go ahead with that investment. And we see that 357 is still greater than 350. So we still go ahead with the investment, and we still conclude to say that the investment of the office block is worth more compared to investing into a government security. So the present value of cash flow in year 1 at 400 kwacha, when it was 7%, we saw that it gave us 374. And we now conclude to say that higher required rates of return cause lower PVs. Why do we say so? Using 12%, we got 357. And using 7%, we got 374. The office building still makes a positive contribution to value, but the increase in your royalty is smaller than in our first calculation, which assumed that the cash flows from the project were risk-free. So like the assumption in our earlier calculation of 7%, we assumed to say that the cash flows were risk-free, meaning that it had zero risk in investing into that investment. But when we attach some risk to that investment, we see that the cash flows were lower to 357 from 374, which was 374 to 357. And then when we calculate the net present values of the two, we see that the net present value of 374 and 350 gave us 24, and this when our interest rate is 12%, the net present value is giving 7 million kwacha. In alternative decision criteria, we can use the rate of return rule. We can state our decision rule in another way. That is, your investment venture is worth undertaking if its rate of return exceeds the opportunity cost of capital. So we saw the opportunity cost in our first example was 7%, and then in our second example, the opportunity cost was 4%. The rate of return is simply the profit as a proportion of the initial outlay. So we can state our decision rule in another way. That is, your investment venture is worth undertaking if the rate of return exceeds the opportunity cost of capital. So if the rate of return exceeds the opportunity cost of capital. The rate of return rule. Example, accept investments that offer rates of return in excess of their opportunity cost of capital. In building projects, for example, the foregone investment opportunity is 12%. Should we do the project? So this is the formula of the rate of return. The profit over the investment. And then this is the opportunity cost. And we say that if your rate of return is greater than this value, then you should go ahead with the project. So we've got 12%. Now let's see if our rate of return is going to be greater than the 12%. So we had 400 million or 400,000, which was the cash flow at the end of year one. And our initial investment was 350. So you have the 400,000 plus the initial 350 over the initial 350. Then calculating the rate of return, we get 0.14. Converting it into percentage terms, we get 14%. And we see that 14% is greater than 12%. Hence, we conclude to say that our rate of return is greater than the opportunity cost. And thus, we should go ahead with the project because it is worthy undertaking. Opportunity cost of capital, also called the hurdle rate or cost of capital. It is really the foregone return of investing in option A rather than option B. So that is opportunity cost. You decide to invest in option A, you forgo option B. That is what opportunity cost is. Opportunity cost of capital depends on the investment opportunities available to investors in the financial market. So you make opportunity cost at the end of the day if you've got a number of investment opportunities that are available. And you as an investor, you have to be rational. You have to compare the risks and the returns of investment A, investment B, investment C. And from the investments that you're going to compare, you will be able to come up with one single investment that you venture in, and those others that you haven't ventured in, they're going to represent your opportunity cost because they are the foregone earnings or the foregone investments that you would have done. An example demonstrates this point. You may invest 100,000 kwacha today. Depending on the state of the economy, you may get one of the three possible cash payoffs. So you've got the economy and the payoffs. So when the economy is in a slump, you get 80,000 kwacha. When the economy is in normal state, you get 100,000 kwacha. And when the economy is in a boom, you get 140,000 kwacha. So the expected payoff at the end of the day, we are going to add all these payoffs and then we'll divide them by 3. If there were 4, we were going to divide them by 4, just like that. So we've got 80,000 plus 100,000 plus 140,000. Dividing the summation by 3, we get 110,000 kwacha. So example continued. The stock is trading for 95.65 kwacha. Depending on the state of the economy, the value of the stock at the end of the year is one of the 3 possibilities. You conclude that the risk of this stock and your investments are identical. So you've got the stock This is an investment in a stock, which gives us 80 when we are in a slum. When we're in a normal state of the economy, we get 100, and when we're in a boom, we get 140. The stock's expected payoffs leads to an expected return of, so the payoffs in our earlier example was 110. And then the expected return, we get 110, which was the profit. And then we add it to the investment, which was 95.65, which was our initial investment, divided by the same initial investment, which was 95.65. It gives us 0.15 or 15%, which is our rate of return. And we see that in our example, it is going to be greater than the opportunity cost of capital. Hence, we should go ahead with the investment. This is because the rate of return in investing into that stock or asset, it is greater than the opportunity cost of that capital. So we only invest into something if the rate of return is greater than the opportunity cost of capital, which is being represented by the interest rate. So in our examples, we saw that our interest rates were 7% and 12%. And our calculations for the rate of return, in our first example, calculating the rate of return, we got 14%, which was greater than the 7% and the 12%. In our calculation for the stock, again, we get 15%, which is also greater than 7% and 12%. Hence, we conclude by saying that this is the expected return, opportunity cost. This is the expected return that you are giving up by investing in the project rather than the stock market. In other words, it is the project's opportunity cost of capital. So in this example where we are comparing the payoffs that we can have, whether we invest into our project today or we invest into the stock market, and we see that these were the payoffs that we would have received if we invested into a project, which gave us the expected return of 110. So calculating the percentage, we see that from this calculation, we'll get a 10% increment. Then calculating the rate of return, if we were to invest into a stock, the rate of return is 15%. And we conclude to say that if the rate of return is greater than the opportunity cost of capital, and then in our calculation, we see that the opportunity cost of capital is 10%. Comparing the 15%, we see that the 15%, which is the rate of return, is greater than the 10%. Hence, we see that if we are making an investment, we have to compare two given figures or two given values in similar terms, in similar time periods. If you are comparing a present value, you have to make sure that you compare a present value to a present value. In our calculations, we had the present value of 350 million kwacha. And we had a future cash flow at the end of year one, which was 400 million kwacha. And for us to compare these two, we had to make sure that the 400 million kwacha was discounted for into present value. And we saw that calculating the present value using a 7% interest rate, we discounted the 400 and it gave us a present value of 374 million kwacha. And we concluded to say that we should go ahead with that project, or we should go ahead with that investment if the present value is greater than the cost of the investment. This is because if we have that value being greater, meaning that it wouldn't profit us to go ahead investing into something that is of higher cost compared to investing into something that is of lower cost. For example, we had an investment of 350 million kwacha, which is of lower cost compared to the present value of 374 million kwacha. And we see that when we calculate the net present value again, which says that only invest into an investment if the net present value is a positive figure at the end of the day. And we see if we calculate the NPV, subtracting 374 minus 350, we get a positive value of 24 million, which is a positive value. And then we also looked at the rate of return. If the rate of return is greater than the opportunity cost of capital, we should go ahead with a given investment. Then the opportunity cost of capital was represented by the interest rate, which was 7%. And calculating the rate of return, which is the profit over the investments, where you get to have the future cash flow, which was 400,000. You add it to 350, and then you divide it by 350. It gave us 14%. And then we say that this 14% is greater than the 7%. Hence, we go ahead with the investment because it is worth undertaking. Thank you very much all for being in attendance or following today's lecture, which was looking at the opportunity cost, the rate of return, and the valuation of investments. You enjoy your day.